Hello and welcome. So today we're going to talk about the long-run model of the closed economy, which is also sometimes called the aggregate model or the classical long-run model. The model in a general sense shows us how an economy will behave or behaves in the long run. And then this overview is kind of designed for an intermediate macroeconomics level, and I'll try to get through this overview as quickly as possible. So I'm sort of assuming that you either have a textbook or you've watched a few lectures before you start with this. This is sort of an outline of what I'm going to cover, so if you want to skip ahead to any of these topics like production function, the supply side, demand side, equilibrium, have a look at the video description and I'll have links to where you could skip ahead. It's also important to note that there's kind of two ways to think about this model in a macroeconomics class. There's the setup of the model, and then there's uses of the model. The setup of the model is what's usually covered in the textbook, what I'm going to go over now in this overview, usually what you see in lecture. And then there's uses of the model, and uses of the model are pretty much what you're going to see on problem sets and exams, and I'll have links to kind of applications of the model that you could have a look at after this. Awesome. So, okay, first off, what kind of, existentially is this model? What does it do? So it's kind of, one way to think about it is that it's a model of an organization of the components of an economy. So, there's a supply side with factors. So you have capital, labor, other factors that go into production function. There's a demand side that determines consumption, investment, government spending. It's an economy that kind of aggregates many, many parts, so many firms, many people. And also it's an economy, it's a model that has an equilibrium. So we assume that markets are going to clear. There's going to be an equilibrium price, which is the real wage. There's going to be an equilibrium price for capital, which is the rental rate of capital. There's going to be a real interest rate that pays savers for their investments. And then another way to think about the model is that it's a model that we could just show cause and effect. So it gives us a way to see how changes, or sometimes called shocks, or economic scenario affects other things in this economy. So changes might be changes in government spending, changes in taxes, technology, incentives to invest, proclivities to save or consume. We could see how tweaks to all those little things, so shocks or economic scenarios, might affect the rest of the model or rest of the economy. But it's also a very small model. It's a model with only a few equations to describe a giant, huge, an economy the size of a whole country. So in order for that to be possible, it's a model of many, many simplifying assumptions. So first off, it's a model of the long term. That's important to remember when you think about using the model. So this won't explain what happens day to day in the economy. In fact, so it's not going to explain, for example, this week's job numbers. It won't explain what recently happened in the stock market. It also has strong ceteris paribus assumptions. So everything else being equal, holding else everything perfectly constant, which is something that never actually occurs in an economy. It assumes markets clear perfectly, for example. So that's how we get all those equilibrium prices and quantities. So many of the assumptions don't hold up in the short run, and they might not even hold up really in the long run. So an example of another assumption of this model is that it's the model of a closed economy, so an economy that doesn't trade with any other countries, and there's really no closed economies out there. But still, this classical model offers some interesting insight, and it's useful. It's probably required for your class. So it's usually the first model you're going to learn in an intermediate macroeconomics class. So let's get to it. So first off, there's the production function. In this model, actually, the production function doesn't play too big of a role, but it's definitely going to play a bigger role in other models, like the solo model to come. So what is a production function? Production function is it's basically a function that takes inputs or factors, so things like capital and labor, to produce stuff. So Y usually stands in for output, real income, production, that sort of thing. For this economy, this is like a production function for an entire economy. So this is an aggregate production function. It tells you how much the whole economy, all the production of all firms, small and large, how they convert labor and capital. Capital are things like, offices and factories, computers, and combines it with the current state of technology to produce something of value, and the value is measured by Y. So first off, So here's an example of a production function. This takes the form of a Cobb-Douglas production function. So you have Y, and words that people use to describe Y in economics classes are usually like output, production, sometimes real income. And it's a function of these inputs. So in this case, we have it nice and simple with capital and labor, but you might also think that possibly inside there could be land, it could be, energy or oil or something. We don't need those extra things just because it makes things more complicated. So we're going to have just capital and labor. But you can imagine this production function is taking all of those factors or inputs that an economy could have, and it's telling you how the economy, so this is basically all firms and stuff, produce some amount of GDP or output. This A thing in front here stands for technology. So A here stands for technology. It's not a factor, so sometimes it's left out of production functions. Sometimes they assume A equals 1, but sometimes you'll see it there. It's kind of a number. So it takes the capital and labor part of the equation and then multiplies it. So one way to think about it is if there's a certain level of capital and labor, there's like a certain quantity of capital and a certain number of people working, more technology produces more production, leads to more output. So given the same amount of capital or labor. So you can think of it as just like a magnification factor. K here stands for capital. Capital is capital, so like office space, machines, that sort of thing. And L here just stands for labor, the quantity of labor. So for capital and labor in the production function, you can kind of think of them as just numbers. Like K for capital could be something like 2, and labor could be, millions or something. And this production function converts those numbers, so the amount of capital there is and the size of the labor force, into how much the economy produces. So a couple assumptions that go here. The first one is going to be diminishing marginal returns. So this is an assumption about the production function. What that means is, have a look. So along the vertical axis is output, so that Y. And along the horizontal axis, we have, in this case, labor, L. So how much does output change given a change in labor? And this is while we're holding capital constant. So all we're doing is changing labor. When we put a little bar above capital, we're telling you it's constant. So obviously, as you increase labor, you're getting increases in output. And that's consistent no matter what level of labor you have. If you increase labor, you increase output. So it's positively sloped. But you also notice that it's kind of concave. It's downward sloping, concave like a cave. So what that tells you is there's diminishing marginal return. So as you increase labor, you get an increase in output. But as you increase labor more, the increase in output diminishes. So over here, a 1 unit increase in labor produces a big change in output. But at these higher levels of labor, a 1 unit increase in labor produces a smaller increase in output. So what we say is the marginal product of labor. The marginal product of labor is how does output change given a 1 unit change in labor. That marginal product of labor is diminishing over time. It's diminishing as you get to higher and higher levels of labor. And this assumption, the diminishing marginal returns assumption, is sort of like the too many cooks in a kitchen assumption. You have only one kitchen with only so many kind of utensils and stove. That is to say, we're holding capital here constant. So as you increase the people working in the kitchen, say going from like 2 to 4 cooks or something like that, you get a big jump in output. But at some point, obviously, the more people you include, you could have them do kind of menial, small tasks like chopping carrots, that sort of thing. There's kind of a point where adding an additional unit of labor is not going to increase the production of that kitchen by much. There's too many cooks in a kitchen. Yeah, okay. And then this assumption also works. So this graph here is all for labor, right? But you could also apply it to capital as well. So you could have replaced, this could be capital, this could be a K. Labor could be fixed with K changing, capital changing, and the marginal product of capital diminishes as well. So given an at a low levels of capital, those first additional units of capital are going to increase output quite a bit. But once you're at a high level of capital, if you increase capital a little bit, output's not going to go quite as much. So this diminishing marginal returns assumption sort of works for all of those factors, is an assumption for all those factors. We also assume constant returns to scale for this model. Don't worry too much about this. First off, what is returns to scale? Returns to scale is given like the same increase in all the factors. So I'm increasing both capital and labor by some amount z. So maybe think of z as doubling it. So that's z is at 2. How much does output increase? So if you increase the factors by some amount and you get the same proportional increase in output, we call that constant returns to scale. We kind of need that assumption for this. So we're going to have that kind of because it's not too far from the truth. It also makes this constant returns to scale assumption makes the model kind of work smoothly. It allows for labor and capital to be paid their marginal products and for the factor markets to clear. But just for now, just know that it's constant returns to scale, and that's okay. There's other types of returns to scale that are important to know sometimes, but starting point for the assumption of the model is constant returns to scale. Okay, but how do you show that it's constant returns to scale? So first off, let's just start off with a production function. So we're going to use this kind of general Cobb-Douglas production function. And then I'm going to increase the factors by some amount. So I'm going to increase it by z. So how I show that here is I take the production function, and then I'm going to increase k by z, and I'm going to increase L by z. So how does that change production? Well, you could pull out z in front of k here, and you could pull out z in front of L here, and you get the following. And then what remains is exactly what there was before. So all I've done in this step is I pulled out the two z's that were before k and the z before L. We get this. And then we have our old level of production. So what's z raised to the alpha times z raised to the 1 minus alpha? Well, we just have to sum up those exponents. So let's do that. So you got alpha plus 1 minus alpha. And what's alpha plus 1 minus alpha? That's just z raised to the 1. And what's z raised to the 1? That's just z. So this simplifies down to z times the initial level of production. And what's another way I could write the initial level of production? I could just put in a y there. So you could see by doubling the inputs, given this production function, I've doubled the output. So that's this condition right here, constant returns to scale. So great, we got this model. We have output here is some function of factors, capital and labor, and then we have like a Cobb-Douglas production function form here with constant returns to scale. But for this model, things are pretty simple. So what we're going to do is just add a little bar to the top of capital and labor, indicating that it's constant. So with constant capital and labor, that's going to say that output is constant. So output is just some level y or y bar, and it stays the same. So that's a nice simplifying assumption. Okay, so let's start clearing our factor markets, starting off with the real wage here. First, when we clear this the same way we do any other market, we have a market demand curve and a market supply curve. So first off, the market supply curve is, we're just given a fixed amount of labor, and these labor are pretty kind of dumb little computer agents who are working. So there's a fixed amount of them, and they're willing to work up to however many exist for any price, right? So market supply here, we're going to have defined by L bar. The demand curve here is going to be defined by that production function, so firms. Remember the production function was that concave shape, and it had decreasing, the marginal product of labor was decreasing. So early on, if you add a little bit of labor, you're going to get a big increase in output. However, later on, if you add a little bit of labor, you're only going to get a small increase in output. So if you remember over here, let's say we increase labor by amount 1, the firm gets, or all the firms together get this increase in output. Well, that increase in output is what they have to pay for that extra little bit of labor. So over here, going from C to D, we increase labor by 1 unit and we get this increase in production. That's how much the firm possibly has to pay to this person. So when we think about the demand curve, we're going to have a downward sloping demand curve reflecting the fact that to a firm, these extra levels of labor, that are at relatively high levels of labor, the value to them is smaller than these initial levels of labor. So like the first newly hired people add quite a bit of value, and that's value that the firm could pay them, where at these high levels of labor, extra units of labor don't add quite as much value, and so the firm doesn't have as much money to pay them. So what we're going to have is this equilibrium rule wage. The equilibrium rule wage is going to be where the demand curve, the marginal product of labor, intersects the supply curve, just the quantity of labor. So why is it going to be at this point? Well, first off, think about what are real wages. So real rate wages, are the marginal cost of labor. So what's the additional cost of an additional unit of labor? Well, if you hire someone new, that additional cost is whatever you pay them, their wage. So that's the marginal cost of labor is the real wage. And so if you're a firm and you're looking at this potential hire, and you have some wage that you're going to pay them, how much are you willing to hire them, or are you not willing to hire them? Well, if the wage is less than the marginal product of labor, like how much value they add to you, well, it's as simple as this. If the marginal cost of labor, so that their wage is less than how much added value they're going to give you, you're definitely going to pay them. If the wage is $5 and you think they're going to bring in, $10 of value, definitely going to hire them because you have some profit there. On the other hand, if the marginal cost of labor, the wage, is greater than how much extra value you expect them to bring in, so let's say the wage is $5, but the value that you expect them to add to your company is $1, you're obviously not going to hire them. So you're going to have this equilibrium set where the real wage is going to be set where the real wage is equal to the marginal product of labor. Think about it. If you have a wage way up here, you have labor supply is greater than the quantity of labor demanded. So supply is greater than demand. And so you have this extra surplus of labor. These extra workers, on the difference between supply and demand, they are a surplus and they're not working. And so what they'll say to any of these workers here who did hire someone is, we'll pay us a little bit less and we'll work for you. So anytime we have a real wage above the equilibrium up here, you have a surplus of labor. So you have these people who are not working. Any of them, if given the choice between nothing or saying to a firm like, hey, pay me a little bit less, they'll say, hey, pay me a little bit less. And anywhere down here where the wages are below the equilibrium wage, you have a greater demand than supply. So all of these firms are willing to say, hey, work for me for this slightly higher wage. So right here you have so anywhere below equilibrium wage, you have a shortage where there's more demand than supply. So any of these firms who would be willing to supply at that wage would come back to those workers and say, hey, I'll work for me and I'll pay you a little bit higher wage. So anytime wages are below the equilibrium, there's this pressure for wages to go up. Anytime the current real wage is above the equilibrium, there's a pressure for prices going down. So in the long run, remember this is a long run model, you're going to have wages work out to this equilibrium real wage, where real wages are equal to the marginal product of labor. And then the exact same logic works for the real rental rate, which is like, workers earn a wage and capital earns a rental rate. So you're going to have the equilibrium real rental rate of capital. It's going to be equal to the marginal product of capital. Okay, so we've talked about how things are produced with the production function, and there's factors or inputs that go into the production function, capital and labor, and then we just talked about how those factors are paid. So wages are paid to the labor, and the rental rate goes to capital holders. So we've taken care of one side, kind of production or real income, but let's talk about the other side. So when you're labor, you get paid income, or you're a capital owner, you get paid the rental rate. Then what do? So you've earned this income, and now what? So there's another side of the market. This is the demand for goods and services, and then this is set up using aggregate expenditures. So aggregate expenditures, can go to in this model one of three places, right? You got consumption. So there's these goods out there that are kind of consumer goods, so consumer demand for consumption goods. There's I here, which is investment. So there's a demand for investment goods. Investment goods are pretty cool because they give you their a rate of return. So they earn a real interest rate. We're going to call R. Oops, lowercase r. Capital R was the rental rate of capital. Lowercase r is this real interest rate. Actually, it's divided by price level. Okay, anyway, so lowercase r, real interest rate, that's what investment owners of investment goods get. And then there's G, which is demand for government goods. So it's just set by the government. Government chooses what it is. So number one, let's talk about the demand for consumer goods. So the demand for consumer goods is a function of incomes, Y, and taxes, T. So in another sense, the demand for consumption is a function of disposable income. Disposable income being the difference between how much you earn overall less the taxes that you pay. So all the money left over is your disposable income, and that's what you could spend on consumption goods. So if your income goes up, we expect your demand for consumption goods to go up. If taxes go up, that's going to cut into your disposable income, and you expect your demand for consumer goods to go down. So nice little upward slope thing. The slope of it is the marginal propensity to consume. That's some tweak that we can make to the model later on. You can imagine a test question where it's like, given a change in the marginal propensity to consume, what's going to happen? So that's the demand for consumption goods. Number two, let's talk about investment goods. So investment goods have a supply and a demand. For the demand of investment goods, these are the firms that would borrow investment goods to make purchases of capital. So in order for firms to pay for capital, they have to borrow some money. They borrow the money from the supply side, which I'll get to in a second. And how much do they want to borrow? Well, that's going to be a function of that real interest rate R. So if the interest rate happens to be really, really high, so at high levels of interest rate, the firm is thinking, well, I have to pay quite a bit for investment, so I have to pay quite a bit to borrow this money. So fewer firms are going to want to invest, and so you'll have a relatively low amount of investment. So if the real interest rate goes up, you expect investment to go down. However, at low rates, at the low real interest rate, that means borrowing money is relatively cheap for these firms. So at a low level of real interest rates, you expect a higher level of investment, because at low levels of low cost to borrow, there's going to be more firms who want to invest. So now let's talk about the supply of investment goods. So this is savings. Where might investment goods come from? Well, consumers in the economy and people who are earning a rental rate of capital, they have some extra money, so some difference between how much they earn and how much they spent. And that extra money is their savings. And that savings could be invested into firms who need to borrow money to pay for goods. So there's two kinds of savings. Yeah, private savings. Private savings are, the savings of people. So you have a certain amount of income, Y. Total private savings is going to be equal to how much income there is, minus how much they spend on consumption, minus, and remember, consumption is a function of this stuff, but you might want to simplify it. Just think of it as consumption, less how much they've spent in taxes. So the difference between how much they earn and how much they had to spend on things, so consumption, and taxes is going to be private savings, but there's also public savings. And public savings is how much money the government has saved. So they have an income of taxes, right? And they have amount of money that they choose to spend, which is just G, just government spending. So when you add those two together, you get national savings. So national savings is just private savings plus public savings. So these two terms right here, you'll notice one has a minus t and one has a plus t. So those things cancel out, and you get national savings of income, less consumption, less government spending. Also note that none of these things are a function of the real interest rate. So what that means is savings is going to be this vertical line here that's fixed. So savings is just some amount equal to national savings. So savings is equal to this little relationship right here. And it's a nice little vertical line. We could also, so that's the supply of loanable funds. What about the demand of loanable funds? That was our investment curve here. So we got a supply of loanable funds here, defined by savings, so how much money people have left over to save. We have the demand for loanable funds here, set by firms who need to borrow money in order to pay for capital. And then the supply curve is just going to be some fixed amount because all of the inputs of the supply curve are fixed, output, consumption, government spending. And then you have an investment curve shaped like this because that's the shape of the marginal product of capital. And so you're going to have a real interest rate here that equilibrates such that the supply of loanable funds is going to be equal to the demand for loanable funds. Any real interest rate above that equilibrium is going to have more savers than demanders, than potential investors. So there's going to be some portion there, the shortage, the surplus of savers. And those extra savers there are currently earning nothing, so they would all be willing to offer a little bit lower than the current real exchange rate in order to get some demander. So anytime the real interest rate happens to be above the equilibrium, there's going to be pressure to go down because of those extra savers not earning anything. And then similarly, anytime the real interest rate is below the equilibrium, there's more demanders than there are suppliers, and all those demanders are saying, hey, I'll give you a little bit higher real interest rate if you allow your savings to come to me. So anytime the real interest rate happens to be below the equilibrium, you're going to have a pressure for the price to go up, so that in the long run, you're going to have an equilibrium such that the real interest rate equilibrates supply of loanable funds to the demand of loanable funds. So let's kind of summarize what we have with this model. We have aggregate supply, and that's such that savings is equal to output minus consumption minus government spending. And remember that output here is a fixed amount, so we're going to put a bar above it because there's a fixed amount of capital, fixed amount of technology, fixed amount of labor. Consumption is a function of disposable income, which was income minus taxes. And since income is fixed in this model, and then taxes, set by the government, so we're going to have fixed in this model, then consumption is fixed in the model. That's why we have this kind of vertical savings line. And then government spending, set by the government, we're going to say is fixed. So that's how we have this vertical supply for aggregate supply. Aggregate demand, well, what goes into aggregate demand? I'm describing the loanable funds market. So aggregate demand here is equal to what are the demand for kind of all the things that the economy produces. So you have consumption, which is a function of disposable income, and all these things are fixed. So we put bars above them. So consumption is fixed. There's investment. There's a demand for investment goods, and that's a function of the real interest rate. And then there's government spending, and that's just fixed. So aggregate supply is defined here by that production function. So you have y is equal to f, which is a function of all the factors. Remember that capital is fixed here, and labor is fixed here. So that means production is going to be fixed here. And then equilibrium is going to be such that the amount produced, so like the amount of real income, is going to be equal to the amount demanded. Most of these things are fixed, so output's fixed, given by the production function. Consumption's fixed. Government spending's fixed. The only thing here that could switch and tweak is going to be the real interest rate. So the real interest rate is going to equilibrate in this economy. It's going to go up or go down in order to bring this kind of description of how the economy works into balance. And so we have a nice little simple model here where we have determined for us output based on the production function, wages, the real interest rate, all of those things coming together in one very simple model. And then, so what else can you do with this model? Well, you can imagine us making little tweaks here and there. So like, say, adjusting people's propensity to consume, adjusting government spending, adjust taxes, adjusting people's proclivity to invest, adjust the level of capital, adjust the level of labor, adjust technology for the production function. I think there's a couple more things to adjust, but you can imagine tweaking any of those little things is going to have some real impact on the rest of the economy, and you could see the effect of those changes using this model. And so that's what we'll do with the next video. Hopefully, I went as fast as I could. Hopefully that was helpful. If you have any questions, let me know. And if you found this video helpful, if you could click like, that would be awesome. Thanks, and have a good day. Bye.